Welcome to another Technical Tuesday episode number 2, and today we are going to be looking at Fibonacci levels. These are levels in the market where you can find hidden support and resistance levels that can act as potential buying or selling areas to enter trade in the trending market direction. These Fibonacci levels are best used in conjunction with other technical analysis tools like the horizontal support and resistance areas, trend lines, or chart and candlestick patterns. Fibonacci levels are used by forex traders to determine key exit and entry levels in the market. So let's dive right into how you guys can draw and analyze the Fibonacci levels in the market. As you can see, this is the Canadian Shiffy chart with 4-hour candlesticks, and if you go to this left-hand toolbar and you press on the Fibonacci retracement, you can see this is how you draw Fibonacci levels like that. And just a quick tip, if you are on a uptrend, a increasing market like this, you draw your Fibonacci levels from the bottom to the top, from the swing low over here to the swing high over there, and on vice versa. When you are on a downtrend like this, you draw your Fibonacci levels from top to bottom, or from the swing high to the swing low over there. So that is how you draw your Fibonacci levels on the different trending market directions. This is the basic template of the Fibonacci tool on TradingView. If you want to edit it, just double click on it. You can remove the background, you can remove the trend line, you can add different colors to your different levels, and you can play around with it a bit, but I don't like the default tool on TradingView, so I used my own Fibonacci levels, and I just used the most important levels, and this is how I represent mine in the market, from 0 to 100 with the different retracements in between. These would be good entry points in between these levels, and good exit areas to exit the trade would be over here, but we'll get into that later. So let's look at the specific chart, and let's just draw a quick chart pattern over here that you can use in conjunction with your Fibonacci levels. This is a triangle chart pattern over here. As you can see, it broke out of the bottom, retested the bottom trend line, and it continued lower. So using your Fibonacci levels in conjunction with this specific triangle pattern, let's just use the bar replay tool. Let's, for example sake, take it over to this area over there. Now let's say you are looking to enter a retracement level from this upward move over here. You are looking to buy the Canadian dollar Shiffy, so you place your Fibonacci from the swing low to the swing high, and you wait for the market to react to any of these Fibonacci levels. Just because market is at, for example, the 50%, doesn't necessarily mean that you can just buy it right here. There needs to be a reaction from candlesticks. And if we just fast forward a bit in time, as you can see, price is having a reaction over here at the 78.6% retracement level. So as you can see, it's consolidating over here. This would be a good opportunity to enter a long trade at this bullish engulfing candle. At candlestick closure you can just enter buy trade, stop losses below the recent swing low or the 100%, and you can put your target maybe at the top of this trend line. So you can see how clearly price reacted to this 78.6 retracement level over here, and what we can expect now is for price to make a move higher to continue the previous uptrend move. So if we just fast forward a bit, as you can see, price made a move higher, it's continuing higher, and there would have been your exit for the trade. Like I said, entry over there, entry at the bullish engulfing, and then your profit would have been at the top of the triangle. So let's just go to the live trading example now and remove these areas. So that is one example of Fibonacci on the uptrend. Now let's look at Fibonacci on a downtrend. Let's look at this move over here, the more recent move. So for downtrends, you just drag it from the swing high, the top over here, to the bottom, the swing low over there. And as you can see, price tested and reacted at the 38.2% Fibonacci retracement level once and twice, and it looks like it's just aggressively continuing this previous downward move, and it's going lower. So this would have been a good short entry over here at the closure of the bearish engulfing. As you can see, price reacted at the Fibonacci retracement with your stop losses above the following Fibonacci retracement level, just in case price goes higher, tested this 50 and then decides to move lower. It's good to always put your stop losses above the following or the next Fibonacci level, and then your target area would be this minus 27% Fibonacci level over there. So that is two examples of Fibonacci, and let's just look at another third on the dollar Canadian dollar chart, also 4 hour. And if we look at this downtrend over here and we draw it from the swing high over there to the swing low over there, we expect some sort of retracement and a move lower like that. And as you can see, price tested and reacted perfectly to this 61.8% Fibonacci retracement level over here with candlestick closure at this level to the pip. That's just a perfect entry over there. So again, this would have been a good short setup at the candlestick closure of the bearish engulfing candle over there. Stop losses above the following Fibonacci level, or to be more conservative, above the 100% level if you want, with your target at this level over here, the minus 27%. And this trade just played out perfectly. So that is how you can trade the Fibonacci levels in the market. So just be aware of these levels in the market, look out for them, use the Fibonacci tool, and just remember for some sort of indication like this to enter a trade. And don't just enter a trade because it's at a level. Wait for a bearish or bullish engulfing candle setup like this, and that's just to improve your chances to catch a trade correctly. So that is Fibonacci in a nutshell. Hopefully you guys learned something from this Technical Tuesday episode, and I will catch you guys in the next one. Bye bye.